In the late 1990s, the markets were going through a period of time of volatility. And as I was meeting with our clients in our regularly scheduled progress meetings, I had two clients ask very similar questions. And essentially, it was, how are the big investors doing? They wanted to know how the big dogs were handling that period of time of volatility. And essentially what they were asking was, how are the institutional investors doing compared to the smaller retail investors? You see, the institutional investors will manage upwards of and more than $50 million. They're the pension managers and managers of large foundations. I began a 2-year process, and as a result of that, it redefined and challenged the status quo of retail investment advice. You see, what I discovered were the big dogs actually were having a much better investment experience than the small investors. And I could boil it down to 3 reasons. The first was the institutional investor had a better understanding of their costs in accessing investments. And as a result of understanding those costs, they were better able to compress those costs down. Second, they understood diversification. Their diversification was built on academic research, not research coming from a marketing department. The portfolios were globally diversified in large companies and small companies. They were diversified in stocks and bonds, and it included the differences between growth companies and value companies. Third, the institutional investor was not prone to the emotional behavior of the small investor. They didn't buy stocks or mutual funds at the wrong time for the wrong reasons, or sell those mutual funds and stock positions at the wrong time for the wrong reasons. They implemented a discipline over a long period of time. Our clients believe what we believe, and they behave like the big dogs, the institutional investors.